All right, guys, welcome back. In this video, we're going to look at some actual mortgage rates, the costs, the closing costs involved, amortization tables, and play around a little bit with the down payment, with PMI, things like that. So where I like to go for this is Box Home Loans. They're a mortgage lender, but the nice thing is they provide instant quotes on their website without entering in your information. So they're not going to constantly send you emails until you use them. So you don't have to give any of your info and you get all of the information that you need. So we're going to just go ahead and start here in this scenario. So we've got a $450,000 home price. We're planning right now to put down 20%. So we're getting a loan of $360,000. Fill in the rest of this info and then go ahead and just click get rates. And these update daily based on the rates. Again, as the prime rate changes, right, the federal interest rate or talk changes, then yields change and the mortgage interest amount changes. So here we have fixed rates and variable. Again, we're not going to really talk about variable. We're not just going to get into those details. It doesn't make a whole lot of sense right now. It could in very specific circumstances, but we're going to mainly focus on fixed rates. So as you can see here, they have a number of terms, 10, 15, 20, 25, 30. So a wide variety. Let's just go ahead and look at a conventional 30-year fixed. They have 19 rates available. And here are the top 4 with their most popular there highlighted, okay? So just a couple observations as we look through this. Number one, interest rate here is 3.625, and then it goes up from there, 3.75, 3.875, 4.125. Here is the payment, the monthly payment that you're looking at. This is just the principal and interest, okay? This does not include taxes and insurance. So this is just P&I. Then you have lender fees, total costs, closing costs and things like that for the loan, and then the APR. Now, what's interesting here is you can actually pay out of pocket for your closing costs, or you can do what's called essentially buy out the closing costs with a higher interest rate. So as you can see here, as you increase your interest rate, your total costs out of pocket go down to the point where at 4.125, you're paying zero out of pocket. Now, why would somebody want to do that? Why would somebody want to get a higher interest rate? Well, if you look at it, you're paying zero out of pocket and you're deciding to put that cost into the overall cost of your 30-year loan. So if we look at the payment, it only increases from $1,641 to $1,744. It's about $100 per month that it increases. So per year, you're paying an extra $1,200. And essentially, you're going to break even at some point after over 5 years. So it'd take about 5 years to break even on this payment and the closing costs, okay? So obviously, in the long term, on a cost perspective, it makes more sense to take the lowest rate possible and then pay for some out of pocket. But you can do anything in between there, okay? They're willing to work with you. You can look at all of the rates and they have, it's going to be on a spectrum here. Okay, so let's just go ahead and look at this one first. Or we'll look at their most popular one, 3.75. So what we're going to do is we're going to look at the amortization table. Amortization table is essentially what the payments look like throughout the whole loan duration, that 30 years. And so you're going to see that the first payments due May 1st. Here is the full payment. This is what's going to interest. This is what's going to principal, okay? And then it shows your remaining balance. So if you see here, the longer the loan, the more that your payment at the beginning is going towards interest. It's about 2/3 to interest, 1/3 to principal. And you can see here as you go down that this number gets a little bit smaller and this number increases, okay? So they just it's like a teeter-totter, a seesaw. And by the end of the loan, the vast majority of your payment is going towards your principal and very little to interest, okay? But at the beginning, it's front-loaded. Yeah, that's important to realize. So let's go ahead and look at year 15, for example. Halfway through, already we're paying more in principal than in interest each payment, okay? So total interest paid, let's go to year 30. As you can see, the interest, they're basically paying zero, right? The vast majority of it is going to principal. And your total payments for that house, just over $600,000, okay? The total interest that you're paying, so remember your principal loan is $360,000, the total interest you're paying is $240,000, okay, over that time period. Okay, so a couple very interesting observations here. Though the interest rate can be low, because interest is front loaded, you're paying a lot in interest in the beginning years. So you can see here in just year one, 66% of your payment is going to interest, and only 33 or 34% is actually going to build equity in your home. So in the first, I would say 7 to 10 years of a 30-year mortgage, you're not really putting a whole lot of money into, you're not really adding to the equity of your home a whole lot. So if you are looking to buy a home, you're saying, yeah, I don't know if we'll be here more than 2 or 3 years. Maybe we'll move, or maybe 5 years and then we'll move. You really have to look at the math here, because you're not adding, let's say you stay in the house for 5 years. You're only paying off $35,000 into equity. Okay, you're only building $35,000 of equity over those 5 years. And you've paid $64,000 in total interest. It's quite a bit. So when we think about the conversation of should I rent or should I buy, rent is throwing money away, so it's probably better to get a mortgage. Well, maybe in the long term, if you're going to stay for a long time, then it can start to make sense. But if you're only going to be there a certain number of years, you're really not putting that much money towards equity. In fact, most of it is going towards interest. Okay. This is the other interesting thing about paying off a mortgage early, is the vast majority of the interest that you're paying happens in the first 8 or so years. And so if you really want to avoid paying a ton of interest, you would have to pay off your mortgage within the first number of years for that to even make sense. If you just add $100 more a month, you're going to pay it off earlier, but you still will have paid the bulk of the interest already. So this is the amortization table. Now, I want you to see what this looks like on a 15-year loan. So we'll go to their most popular. That rate is 2.875, quite a bit lower. Let's look at that amortization schedule. So here at the beginning, there you go. You can see in this type of loan, it's the reverse. There's about 2/3 of your payment is going to principal, and about 1/3 is going towards interest. If you zoom forward to the end, your total payments are $443, and the total interest that you have paid is $83,000. That is a substantial difference, right? It's $443 total out of pocket instead of $600,000. So if you look at the payment though, the payment is $1,667 on this 30-year. On this 15-year, it's $2,464. Okay, so about an $800 additional each month. Okay, it's about 50% more in a payment every month, because you are paying a lot more off sooner. So I want to show you how the amortization table kind of works. That's how they keep a level payment for every month throughout the whole term of the loan, is because they just slowly adjust the interest and principal, and they've run the calculations and it works out that way. So it's a steady payment that you can count on month in and month out. So I hope that helps. So if you have questions, or if you want to jump in and look at what actual rates are, this is a great tool to use. You can also say, hey, I want to refinance, cash out, yes, no, property value, what's your loan amount, all of that. You can look at what a refinance would look like as well, and kind of run the same type of scenarios and say, hey, do I want a 15-year? Do I want a 30-year? How much in interest do I want to pay? So I hope that helps understand some of those basics and kind of understand some of this amortization table and the factors that go into that. Now, the last thing that I want to do is show you PMI, okay? So let's say that we want to put down 5% of our $450,000 sales price. We're going to update rates. What happens here is on this 30-year mortgage, we're going to look at the details. All of a sudden the payment, because obviously it's a bigger loan, right? The payment goes up quite a bit. If we look at right here, the amortization table, you can see that $188 of that is mortgage insurance. Okay, so you have not only the interest and the principal, but you also have mortgage insurance added on there. Okay, and like I said, at some point this is going to fall off. So let's jump forward 5 years. So it's still there. Like I said, it can fall off. It depends on the way that you have it set up. But once you get about 20% equity in the home, that private mortgage insurance can fall off. So that happens here around month payment 100. All of a sudden it falls off. So then your payment drops by about $200, right? $188. So that's kind of an example of that. Now, the same way that you can buy out your closing costs, you go buy out these closing costs with a higher interest rate, you can actually do the same thing with private mortgage insurance. You can just say, hey, I'll pay a higher interest rate to not have to pay private mortgage insurance. So you might have to find a broker that does that, but I know that they're out there. I've done it before. When we bought our first home, cash flow was more important to me than the long-term cost of owning the home. And we were buying such a low value anyways. And so we ended up doing that. So our interest rate went up. We bought out all the closing costs and we bought out our PMI. And we still had an extremely low mortgage payment, but we had better cash flow for the entire time. We could use some of that cash to maybe do some remodel or some fix-ups or other things. So I'll wrap this video up here and we'll talk about a few other considerations around mortgages in the next videos. See you soon.
Understanding your mortgage is the first step toward financial freedom.